Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Hey guys, welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And with us today, we have a very special guest, Eric Auslander. Eric, welcome to the pod.
Thank you. I appreciate the opportunity on joining the podcast.
Yeah, excellent. Before we dive into the details of your property, Sherwood Townhomes, it's a 24-unit multifamily in Charlotte, North Carolina. Talk to us a little bit about yourself, your background, and where you are in the multifamily space.
Sure. I recently started up my own real estate investment firm in August 2022, focused on real estate syndications, as well as joint venture partnerships. I do have some background in real estate. Prior to launching my own firm, I worked with Morgan Property. They're the third largest owner in the country. And I worked in like an acquisitions role. I was part of acquiring over 65,000 units with them and really getting them up to their top 5 ownership status. Learned a lot from them, especially how to underwrite, how to find deals. And now I'm using that knowledge to do it on my own as well.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
That's amazing. Yeah. Taking your skill set and building your own wealth and empire. I love it. Let's dive into the details. Okay, so we got Sherwood Terrace. It's a 24-unit multifamily in Charlotte, North Carolina. You actually mentioned it's in a suburb of North Carolina, correct?
Yes, it is. It's in Kannapolis, which is about 20 to 25 minutes north of Charlotte, off of Interstate 85. And,
okay.
Nice growing little suburbs, got some little downtown vibe, a lot of development going on. The I-85 corridor, a lot of new businesses sprouting up as well.
Oh, it sounds like an amazing market. So when did you first acquire this property? What was the date that you closed? And then let's start diving into details on how you found it. Did you use a broker? Was it off market? Give us some insight there.
Sure. So we closed on November 1st and we found it on a LinkedIn post, actually. And it was quote unquote off market, but it was like an off market broker. We had connected in the past while I was at Morgan. We had never done a transaction, but I saw this post and I was like, hey, this is like a perfect deal for me to get started in my own platform, 24 units. It's not like I have to go tackle a 200 unit complex as my first deal. And for the price that was floated out there, it seemed to make sense. I say 9 out of 10 deals that I find that are like the off market, that are being shopped quietly by some local or national brokers. Typically, the price that either the seller or the broker is indicating doesn't make a lot of sense. So you got to review a lot of these. This one made sense to me, and I put my best effort forward to try to acquire it.
So talk to us, like, what kind of class of property it is, what vintage, what potential did you see in this property? What was your initial thought on the overarching business plan? And then when did you decide to pull the trigger, and how did you structure your offer?
Sure. I'd say that the class of the property is B or C, depending on how you qualify that. 3 of the buildings were built in 1971, and the 4th building was built in 1981. Mix of like interior renovations. I'd say about half of it has some upgrades and half are quote unquote classic units. Potential for the property, it's in a really good submarket. The median household income in this area is about $80,000. So you have the potential to really bring it. I like to say it's like the worst asset in a really good location, if that makes sense. So it's worth putting some money into as part of your business plan. I guess my vision for this property is a mix of both an exterior renovation as well as correcting some curb appeal / deferred maintenance. So for example, we plan to paint all of the exterior, add some decorative shutters, as well as some metal awnings over the doors to give it a nice little pop, as well as seal the parking lot. In terms of interiors, we're going to go on turn, renovate the units, stone countertops, stainless steel appliances, the washers and dryers, and just generate some more demand for these type of units in this market.
Is there a gap in the rent? Were you seeing that the units were below market rent? And if you did an interior renovation, you can move into market rent? Is that what you were seeing?
Yeah, I saw a gap in terms of their rent roll. There was a lot of, I'd say over half of the units, tenants were there for at least 5 years. So they were getting some renewals. And then some of the new leases that the seller had were at $1,250 a month. And some of the older tenants were $800 a month, right? So there was like proven rent growth just in the rent roll. But in addition to that, I think the market supports $1,300 rents to $1,400 rents, especially with a renovation.
Let's talk about, so you closed in August. When did you actually lay eyes on the property and decide, hey, this is something we want to put an offer in on? And then how did you structure your offer?
Yeah, so quick correction, close in November.
Sorry about that.
August is when I launched and went out on my own. This opportunity came across my desk like within a week of me starting, and went full steam ahead, went and toured the asset when we had some sort of like soft agreement on terms. In terms of price, I think they originally were looking for $2.6 million. I originally came in at 2.5. We slowly worked up to about 2.55 million. And once we had some sort of soft terms, then I went down there to get eyes on the asset, make sure what my vision was for the property fit, seeing the market, seeing the rent comps, seeing the sales comps, and having some more conviction about where we could take this property to. After that, we structured a purchase sale agreement and went forward with the asset. I was able to structure seller financing here at about 80% of the purchase price, which was the perfect same thing for the first time deal because it removed some of my obstacles in getting a traditional loan or even having to partner somebody to do a key principal and qualify for a bigger loan.
Okay. So what were the terms of your loan? What did you do there?
Yes, sure. So it was
number of days due diligence, closing. Did you have to put any money down? When did it go hard?
Yeah, definitely. So we put down probably $40,000 for the deposit. We had a 30-day DD and then a 25-day closing, which we were able to work within that timeline. The loan was structured as a 5-year loan. Full-term interest only, fixed rate at 6%. What I really liked about it is we structured it that it's prepayable at any time at par. So once we finish our business plan in a year or two, we can go target a refinance, deliver capital investors, and secure, in theory, a fixed rate financing, especially if rates fall back down towards the sub 5% range.
Did you initially pitch that seller financing, or was that something that you guys decided to bring later in during the negotiation process?
Yeah, so that was one of the first things that I threw out while I was bidding on the asset. And we were structuring a price that worked for both the buyer and the seller. And it seemed like the gap between the free and clear price and the seller financing price was minimal. It was almost the same. So it seemed very accretive to me to try to go take this down and structure the seller financing.
Okay, awesome. So how many times did you have to go back and forth in the offer structure in order to get an accepted offer? And were there any other buyers looking at this property?
I'd say we probably went back and forth probably 3 times until we got a price that worked and we agreed on. I believe there were some other buyers before me that either put a contract and dropped it. I don't know the full story there, but I know other buyers had looked at this. There was some deferred maintenance at this site, including like concrete patios that were deteriorating, some soil erosion issues. And these are things that we addressed in our capital plan and are budgeted for to fix. I will say, like, a project like this, it was perfect for me as a first-time operator. Whereas if I had 10 different assets that I was operating, I wouldn't even be looking at this just because of the time requirement on my side wouldn't make sense, right? So it's perfect for somebody like me where I can focus on it. And that's why it was a perfect deal for me. So
that's awesome. I want to get into the lending and how you took it down. But before we do that, you've already opened up the door on the due diligence. What did that look like? What was your timelines? And then also walk us through, did you walk every unit? Did you uncover anything? What were some surprises that you had?
Yeah, sure. So our timeline was about a 30-day due diligence. During that timeline, I vetted third-party managers within this market, interviewed about 6 different third-party managers, selected a third-party manager that I felt really comfortable and really agreed with my business plan and vision. And they were a local third-party manager. They managed 800 units in the Charlotte market, and they focused on the sub 100 unit management range, which is a perfect fit for this. In addition to that, we walked the site with 3 different contractors to get competitive bids to do all the deferred maintenance, exterior renovation projects, as well as some interior renovation bids. So we felt comfortable working within our initial capital budget. We walked, I want to say 75% of the units. There was a handful of units that we couldn't get into just because the door was locked and the tenant wasn't there. But after seeing 75% of the units, we had a really good comfort level with the level of interior renovations, both on what's been upgraded as well as what's a quote unquote classic unit. I guess in addition to that, what we found, there was nothing that really rubbed us the wrong way in terms of what we found. I will say that there was a growing water expense that was happening, and it was coming through on the financials over a 3-month period, most likely due to leaks. So what we did is we structured an agreement with the seller that if the water usage was over a certain amount, we would get reimbursed for the usage, if that makes sense. And the only reason that it really works is because it's a seller finance deal, right? If this was a traditional loan, like, the seller wouldn't want to be paying this money back, right, on a monthly basis. So we found some leaks and we've corrected them along the way. In addition to that, we're installing water sub-meters so that we can pass through reimbursements to tenants, as well as target any leaks or any overzealous tenants that like to take 2-hour showers or something like that.
I'm sure that is an issue that you have to look at, right?
Yeah.
Okay, so that's the physical due diligence. With an older building, was there anything that was surprising on the insurance due diligence at all?
Sure. Yeah, there was a couple things here. So there was older Zinsco panels on 2 of the buildings. So this is something that we allocated for in our capital budget. They're actually getting replaced right now as we speak. So that's something that is more competitive to the insurance industry, where you have updated electrical panels. But outside of that, in addition to walking to the site for the 3 contractors, we also hired PCA and Phase 1 environmental / property conditions to go provide an independent study on their findings so we could compare and make sure that outside of what we thought, as well as our contractors, that we were quote unquote checking the box. And that's something that's more typical with a conventional loan like a Freddie or a Fannie. But in this case, it wasn't required because it's a seller finance, but we still wanted to do that extra level of due diligence.
Nothing worse than not doing it and then getting stuck later on whenever you can't sell it.
Exactly.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFINCon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live, in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
All right. So let's turn to the financial due diligence here. What kind of information did you get from the seller? I would imagine with the seller finance deal that they were a little bit more open with providing financials. Were there any surprises? And then how did you firm up that construction budget? And how were you confident that you could execute that business plan?
Sure. Yeah. So we received rent roll, financials, tax bill, insurance, loss runs. We did a lease audit. So we went and reviewed every single lease and make sure the terms matched the rent roll as well as the tenant ledgers. We reviewed all the water bills to make sure it wasn't allocated to a certain water account where the leak was happening. We actually discovered one water bill was actually a neighbor's water bill. So that was interesting.
More about that.
Yeah, there was just, we were looking at the water bill and one account wasn't even related to the property. So it corrected itself through attrition, but it was something that we looked out for, especially when we took over. If we were going to get this bill, we obviously weren't going to, but that was minimal. And remind me the second half of your question here.
Yeah. So there was a level of construction and renovation that you were going to do on this property. You brought in 3 different contractors, you did your phase 1. How did you put together that budget and become very comfortable with the numbers and that they worked in your financial modeling?
Yep. So when I started the process, I assigned, or call it allocated, a certain per unit for both interior and exterior renovations. On the exterior, we were targeting about a $10,000 per unit exterior / deferred maintenance allocation, which at 24 units, that's $240,000. And then we add on some contingency as well. So it's just rounded up to $250,000. So that was what I had in mind on, this is what I'm willing to spend. If we're going to come in substantially higher than that, that's obviously material to the structure of the deal as well as projected returns to investors. That was the number I was looking at working within. And between walking the units and the exterior with the 3 different contractors, we were able to come up with a competitive capital budget that worked within that landscape, as well as some room, because there's things that pop up along the way. Like right now, we're replacing these panels, and there's some conduits behind the panels that also need to be replaced that are going to run an extra $500 per unit or something like that. You got to have
what was your cost overrun that you included? Was it like 10%, 15%?
Yeah, we included a 10% contingency on the 10,000 per unit. So call it 11,000 per unit. But when we finalized our capital budget, we all the way up against the initial 10,000 per unit anyways. So there was some built-in threshold of contingencies there as well.
Let's shift to the financing. Okay, so seller financing. What did you do to make these terms really appealing to the seller? How did you even broach that conversation? And then just backtrack a little bit, catch us back up on where the rate and the terms and what your exit strategy is on that, because that was a few minutes ago when we discussed that. And yeah, let's start there.
So rate and terms, it's a 6% fixed rate, full term, interest only deal, fully prepayable at par at any time for a refinance. In terms of how we structured that, it was hand in hand with coming up with our offer. We originally, I think, proposed a 5% fixed rate. And as we were negotiating between price and rate, because those are both very sensitive to the returns of the deal, we were able to structure a price that made sense with us, as well as a rate that made sense to the seller.
Any sort of penalties for selling early or refinancing early?
No penalties. And that's why it really worked for us. In theory, we could go refinance today, right? Especially rates and treasuries are coming down, 10-year treasuries at 3.5 or below that. And I've gotten quotes at low 5s fixed rate on another deal that I have in the contract. So there's that opportunity that we could go arbitrage it right now and bring that 6% down to a 5% or 5.25%. But Really, I want to execute the full business plan, boost NOI, and then go target a refinance.
That sounds smart. That sounds smart. All right. So let's talk about the capital piece. Walk us through the different layers of the capital stack here. How much did the seller come in at for the seller financing? How much did you buy it in partnership with anybody?
So I am the main sponsor on this opportunity. So I didn't partner with anyone else to be the operator, if that makes sense. The seller provided a note at 80% of the purchase price. Once we add in our capital budget, it turned out to be about 65% of the loan to cost. So the full equity raise here, or the equity that we closed with, was about 1.2. And in that, since this was a first deal for me, I thought it was important to have some skin in the game. So I invested 10% of the equity, and the remaining 90% we did like a friends and family, as well as some accredited investors to go raise the other basically $1 million.
So you worked with the accredited investors only, or do you have sophisticated investors in the deal?
Yeah, this one is sophisticated investors, which is the 506. So we didn't only allow accredited investors. We worked with investors that I had a close relationship with that I know that are sophisticated. And then in terms of the structure that we ran here, it was 8% preferred. So investors get 100% of all cash flow up until we deliver that 8, and then 30% of the sponsor over an 8. And then once we deliver an 18, then a 50-50.
Okay. And are you doing a return of capital or return on capital model?
I'm not sure what the difference is between those two, but whatever capital was invested day one, that accrues yearly at 8% or 18%. And as we distribute and return capital investors, that obviously pays down those accrual balances.
Okay. Awesome.
If that answers your question.
Yes, it does. And then, so you're the sole sponsor. So any additional split would go to you, or do you have to share that? Did you bring on any sort of key partner or anything like that for the loan?
No sort of key partner on this one. The deal that I currently have under contract in Raleigh, that's one that I would be working with another key principal, something like that.
And then how did you structure the fees for this deal?
Sure. So we did a 3% acquisition fee, mostly because it's a super tiny deal. In addition to that, we did a 2% asset management fee just on revenue, not on equity, and then a 6% construction management fee to oversee the renovations and make sure everything gets done in a fashion and timely matter here. Other than that, there's no other fees. There's no guarantor fee. There's no refinance or disposition fee. I wanted to make my incentives in line with my investors as much as possible and deliver those projected returns without me skimming off the top of a refi or disposition.
Awesome. Let's wrap up a little bit here, because this is it sounds like a great first deal, especially launching your company in August and this coming across your desk 1 week later. How fortuitous.
I thought it was too good to be true. When I went on my own, I gave myself a year to get one deal done. And it was a weekend and I have something under contract. And I was like, is this real? But it turned out we got it done. So I was really happy with it.
Obviously, you brought in a lot of knowledge and skills already, right? You didn't have to go learn all that in that first year. And it sounded like you pulled in or tapped into a relationship that you'd already developed. So that's amazing.
Yeah, I won't say that it was you necessarily need that. I think the biggest shift for me and the mindset change is more so becoming a full-time entrepreneur, which is different than being a salaried W-2 employee. It comes with its own competitive challenges as well as level of stress. That's been more so the learning experience for me, as well as being a full-time operator, right? Because where I was at before, I was more so on the acquisition side. We would have a layer of reviewing the performance of the deal on a quarterly basis. But in terms of being involved with the day-to-day, that's something that I'm learning and growing my knowledge and skill set incredibly over time.
That's awesome. All right. I have a couple more questions for you. And
Sure.
I would love you to think back as you went through this process. Were there any other issues that cropped up that we haven't talked about? And what went hard? What was an obstacle? Was there something that was easy that you thought was going to be more challenging? And was there something that you thought would be more challenging that actually was easy?
I will say that what I thought was hard that went easy was actually for this one was raising the equity. I had never done that before. Where I was at before with Morgan, we would do joint venture partnerships with institutional capital partners. So we would bring in one partner to do a deal. Whereas here I had 24 investors in this deal. And it went really quick, and I was fortunate with that. What was hard that I thought was easy, I guess, was really working with vetting and finding a third-party management company that that I really bought into. When you're looking at the 200 unit plus stuff, kind of operates the same way. They have a certain management fee, and it comes down to a lot of these folks are managing 20,000 plus units across the country. They have it down to a science, right? But when you're looking at these 20 to 50 or even 75 unit deals, every third party manager has its different structure. And on top of that, they have a different way of working with the asset as well as the owner. So that was a challenging piece for me. It's just learning that process and really trying to find one that worked with my mindset and business plan, because they're the ones that are doing the day-to-day leasing, and if a toilet's leaking, they're figuring that out. So
it sounds like I initially cut my teeth on single family rentals, and it sounds like a similar problem there, right? You can have your professional management companies and you're a number, or you can have the more high touch relationship with the property manager, and you're just like, you're trying to figure out like where the quality comes in.
Exactly. And it's like, ultimately it comes down to a numbers game, right? Where it's, you sacrifice management fee and pay a little bit higher, but get a better, in theory, like quality of manager that's going to boost rents and keep expenses lower, your other expenses? Or do you go for the cheapest management fee in the game? But in theory, there could be tenants that are applying, and that management fee company or management company just not even calling back those prospects. Your property is slowly deteriorating in occupancy. It's like a balancing act. And some of it you don't really know until you're running it with it. I've been fortunate so far, and I appreciate the management company here. It's AM Realty, by the way, out of Charlotte. So I'll give them a shout out.
There you go. There you go. Eric, thank you so much for sharing your experience with us and your knowledge today. If listeners wanted to find out more about you, where can they find you and follow you?
Yeah, sure. So I am on LinkedIn, Eric Auslander. I have a website. It's called Auslander Capital, and the name of my firm is Auslander Capital Partners. I'm also on Facebook and Instagram, and I think that's probably the best ways to follow me and see what I'm doing. I'm pretty available. If somebody wants to reach out to me, I'm pretty responsive.
Fantastic. Eric, thank you for being with us here today. We look forward to following you and having you back on the show to cover a future deal.
Yeah, Wendy, I appreciate being on as well. As we said before, this was my first time doing a podcast, so it was really interesting to me. And thank you for having me. I really appreciate it.
Absolutely.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.